Hello and welcome to Inderes TV. Harvia released its Q4 report last week, and now I'm in the studio with Analyst Rauli Juva to discuss Harvia and the result. Hello, Rauli.
Hi, Pia.
So let's start with the traditional. What was the tops and flops of Q4?
Yeah, Q4 was pretty interesting, like the CEO put it. So the growth was even quite a bit higher than we expected. So almost 30% growth, part of which was from the acquisition, but also the organic growth was over 20%. So that was very, very strong. But then the margins were actually quite a bit lower than what we have used to for Harvia. It was 16-17% on the EBIT margin. So still a good level as such, of course, but they have been used to being over 20%, which is also their target. So that was quite surprising, which they explained by some campaigns in the US, which hit the margin more than expected. But yeah, that was the overall picture. That very strong growth, but disappointing margin. And then actually the absolute earnings came a bit down year on year, which was surprising as well, but perhaps the reasons were more temporary than structural in nature.
Yeah, so some negative surprises, but probably temporary.
Yeah,
in that sense.
Looks like that.
The US is an important market, so Harvia, of course.
Yes.
But the domestic content in the products in the US is high for Harvia, in 70%. But the implemented and planned tariffs still pose some risks for Harvia.
Yeah.
Can you elaborate on this? What's the risks and how could they affect Harvia?
Yeah, sure. Yeah, the US is the biggest market and the biggest growth potential as well. So it's very important, obviously. And the tariffs can have many impacts. So to begin with, the main product in the US is basically the full sauna cabin or sauna room. So it's a lot of wood. And the wood raw material is partly US based, but also a lot from Canada. Like I understand is in basically any industry using wood in the US. A lot of imports come from Canada. Obviously, there if the Canadian tariffs will be implemented, which are now on hold, that would most likely take up the raw material price for Harvia as well as the whole industry. So that would be pretty much the same for all. But that would definitely have a negative effect on that. Then on the heater side, they do not have any heater production in the US, so that's the 30% which is not made in the US out of their production. So heaters are then imported either from their Chinese factory or from Finland, and that's very flexible. So now when China got some more tariffs, it's likely that they are now shipping more or everything from the Finnish factory, and that's no problem. And then of course, if we would have some tariffs also against the EU, that would have some impact for the heater production. But heater is still fairly small price out of the total if you think about the total sauna cabin. So I don't think that would have a big problem as such. And also generally, if the over time, even if the tariffs would be like the 25% that is proposed for Canada, the demand is quite good in Harvia's categories, and the price points are fairly high. The people buying are rather in the high income level, and also Harvia's pricing power is pretty good. So I would assume that over time those would basically flow into the selling prices. But obviously, if a kind of big tariff comes at any given point, that could have some short-term negative margin impact as well.
Yeah, but in the longer term, probably they can compensate with their own price.
Yeah, that's how I think about it at least.
So you mentioned there was a lot of campaigns in Northern America, and which depressed the EBIT market initially. You also stated in your report that campaigns are a good way to strengthen the market position, which I totally agree with, of course. But will the campaigns continue to have a negative effect on profitability in the future?
Probably to some extent, yeah. So these were like Black Week, Cyber Monday campaigns, something which we haven't seen in the earlier years for Harvia. So that's why it came as a surprise that they had this kind of heavy campaigning. And the reason why they impacted now so much their margin is it was that the wood price actually went up during the second half quite a bit, and when the campaign prices were locked, and that had a more negative impact to the margin than expected. So most likely, yes, they would continue this kind of campaigns, at least in Q4, perhaps even in some other geographies and other quarters if they see it fit, but they shouldn't have so strong margin impact in a, let's say, normal situation. So maybe they also try to manage the margin a bit better going forward, that we wouldn't see so harsh negative impacts. But yeah, most likely we will continue to see some kind of margin dilution from campaigns when they are done.
Yeah, but this year it was elevated.
It was clearly exceptional. Yeah. It was many kind of percentage points from that alone. That was basically the biggest single explanation on the quite big dip at the margin.
Well, every time we discuss Harvia, we talk about acquisitions. And once again, the balance sheet continues to provide resources for this. What do you expect on this front for the next few years? Yeah,
well, they just did like we talked about in the previous video, in the summer, they did basically a perfect acquisition for them. So a steam room or steam equipment provider in the US was very, very good strategic fit, and most likely they would like to continue expanding somewhat, but probably the targets are not that many. So finding a good target and at a reasonable price, I don't think they would. My kind of guess and probability would be that they can't find anything this year, at least anything kind of in meaningful scale. But if we talk about a few years in time, they are likely to do something like trying to take a stronger presence in the infrared side, like we've talked about before, or then just have some maybe a bit more complementary acquisitions in traditional saunas, or entering some geography a bit stronger or something like that. But probably most likely they won't be like huge in size.
Yes. Yeah. So smaller ones and probably a few years down the line after.
More likely, yes.
Yeah. So this year, the outlook, and maybe even next year, what does it look like?
Well, to me, that probably looks like pretty much the same will continue, that what they have kind of shown already for the past few years. So US and the APAC and Middle East segment will continue to grow strong and drive the growth for the group. And perhaps this year, of course, in Europe should be also turning to growth. Last year, Europe, they had two segments, Northern and Continental Europe. In total, those were basically flat last year, and now we were expecting them to turn a bit to the positive this year. Probably nothing huge, but still positive. So that will start to support the growth as well. And like mentioned, we believe that they will come back to quite good profitability. So more on their kind of traditional plus 20% EBIT margin level for all the quarters for this year. So the Q4 would be more of an exception.
Yeah. Okay. And I suppose in Europe, the part of the turnaround would be, or the improvement would come from just the economy slowly improving, and then.
Yeah, for Europe, that's probably the main driver, the overall economic sentiment, and especially in Northern Europe, where the sauna is more of a kind of in every household, impacts more, and then the US and the rest of the world kind of goes just with the increased knowledge and penetration of sauna. So that's a bit of a different game.
Yeah, so that's more new sales, and here is more replacement.
Indeed.
Yeah. And then finally, of course, the valuation and recommendation. What's the position now?
Yeah, we took it a notch up, so it's now on a reduce, or on a sell throughout last year, which was obviously very wrong. Like we can see here on the graph, it was been going quite nicely up. So and the valuation continues to be in absolute terms fairly high. So PE 27, I think, for this year now, and EBIT around 20. So it's definitely not cheap, but this kind of quality company and with very strong growth prospects, you wouldn't expect it to get it with a very, very cheap multiple. So I think it's actually now quite fair if they continue to deliver the kind of growth they have been delivering, and we are expecting. So basically around 10% organic and a bit more now with the acquisition this year. So if that continues, then it should be worth its value. But we are on a reduce still because we see the kind of upside is limited to what we have as a required rate of return. So
yeah. Okay. Thank you, Rauli.
Thank you.
So Harvia, a few negative surprises in the Q4 report, but strong growth still expected. You can read more in the report at Inderes.se.